Compounding is one of the most discussed concepts in personal finance, and one of the least understood. Not because the definition is complicated, because the actual mechanism, the way it operates mathematically, produces outcomes that are genuinely counterintuitive until the numbers are examined directly. Most people understand compounding as growth on growth, returns earning returns, the portfolio getting bigger because the bigger portfolio generates more dollars, even at the same percentage. That's accurate, but it misses the structural property that makes compounding so powerful and so dependent on specific conditions to work. The mechanism works like this. A portfolio generates a return. That return is added to the principal. The following period's return is calculated on the larger base, which produces a larger absolute return, which is added to an even larger base, which generates an even larger return. Simple in concept, but the output is not linear. It's exponential. And exponential growth has a specific property that makes it behave very differently from linear growth over time. The growth in early periods is small, almost invisible relative to the final outcome. The growth in later periods is large, dramatically disproportionate to the early periods. The same percentage return, applied to a base that is compounded for decades, produces a dollar amount that dwarfs what the same percentage produced in the early years. This is why the last 10 years of a long holding period typically generate more absolute growth than the first 20 years. Not because the return rate changed, because the base is so much larger by the time the final decade arrives. A portfolio that is compounded for 20 years generates annual dollar returns that exceed what the entire first 10 years produced. The mechanism rewards patience, not through a fixed percentage on a fixed base, but through an accelerating return on an accelerating base. And the acceleration is invisible in the early years, which is exactly when most investors make the decisions that interrupt it. The second structural property is that compounding is not forgiving of interruption. A year missed is not simply a year's return lost. It's a year in which the base didn't grow to the level it would have reached, which means the following year's return, calculated on a smaller base, is smaller than it would have been, which means the year after that is also slightly smaller, and the year after that. A single year of missed compounding creates a permanent gap, not just for that year, but for every subsequent year of the entire remaining holding period. The gap compounds forward, just like the returns would have. Understanding this mechanism clearly changes how investment decisions get evaluated. A pause that feels temporary, a period of sitting in cash, a year of not contributing, isn't simply a pause. It's a permanent reduction in the compounding base from that point forward. A withdrawal that feels minor, a portion of the portfolio liquidated for a short-term need, isn't just a reduction in the current balance. It's the removal of capital that would have compounded for the entire remaining holding period. The actual cost of that withdrawal isn't what was taken out. It's what that amount would have become by the end of the holding period, which, in a long-term portfolio, can be a multiple of the original amount withdrawn. Compounding is not forgiving, but it's not punitive either. It simply does what it does, consistently, without judgment, for as long as it's allowed to operate without interruption. Most content talks at you. This one sits with you. If that difference stood out, if this felt real instead of loud, like the video, subscribe. This channel is built for people who notice patterns. Most investors focus on return rate. What percentage can I earn? Which fund performs best? Which asset class generates the highest return? These are real questions. Return rate matters. But the evidence on what actually determines long-term portfolio outcomes points consistently at a different variable. Time. Not return rate. Time. The relationship between time and compounding produces outcomes that feel wrong until they're examined directly. Consider two investors, same starting amount, same return rate. One starts at 25, one starts at 35. 10 years apart, same strategy, same rate of return. At retirement, the investor who started at 25 doesn't have 10 years more return than the investor who started at 35. They have significantly more. Because those extra 10 years weren't just 10 years of return. They were 10 years of base building, 10 years of the compounding mechanism operating on the early capital, which then generated returns on the expanded base for every subsequent year. The 10-year head start doesn't produce a 10-year advantage. It produces an advantage that grows with each passing year. The intuition failure here is significant. Most people think about the cost of starting late in terms of missed returns. I missed 5 years, so I'm missing 5 years of returns, which I can make up by saving more or by taking more risk to earn a higher return. That math is wrong. The cost of starting late isn't the returns missed. It's the compounding base that would have built on those returns for the entire remaining holding period. 5 years of missed compounding at the start produces a gap that widens with every subsequent year. Not a fixed gap, a growing gap. Because the base that would have existed would have generated larger and larger returns in each subsequent year, and those returns would have compounded. And the gap between the two positions keeps expanding until retirement. Return rate matters, but it's less powerful than most investors believe relative to time. A higher return rate can partially compensate for starting later, but the compensation is imperfect and requires taking on risk that the longer time horizon would have made unnecessary. The investor who starts early at a moderate return often ends in a better position than the investor who starts late and reaches for higher returns to compensate. Because the early investor's compounding is operating on a base that has had years to develop, while the late investor's higher return is operating on a base that hasn't had the same time to build. The time variable can't be fully compensated for by the return rate variable. This is why financial advice that focuses primarily on return selection, which fund, which strategy, which allocation, misses the most important lever available to most investors. Starting. Not starting with more. Not starting with a better strategy. Starting. As early as possible, with whatever is available, and allowing the time variable, the most powerful variable in the equation, to do what it does over the holding period. The difference between starting at 25 and starting at 35 cannot be fully recovered by optimizing anything else in the investment equation. Time is irreplaceable, and the investors who understand that treat starting as the most urgent decision, not the most deferred one. Compounding is a mechanism, not a philosophy, not a strategy. A mathematical mechanism that operates according to specific rules and produces specific outcomes when those rules are honored or violated. The most important rule is consistency. The mechanism works because returns are added to the base, and the next period's returns are calculated on the larger base. Anything that removes capital from the base or interrupts the process of adding returns to it breaks the mechanism. Not permanently, but consequentially. Panic selling is the most visible interruption. Markets decline. The portfolio loses value. The investor, reacting to the loss, sells to stop further damage. And in doing so, they interrupt the compounding mechanism at the worst possible moment. Not because selling during a decline is irrational, In isolation, it seems like prudent risk management. But because selling during a decline locks in a loss on a smaller base and exits the position before the recovery occurs. The investor who sold has to be right twice about when to exit and about when to re-enter to avoid ending up worse than if they had simply held. And the evidence on investors who panic sell and then wait for the right moment to re-enter consistently shows that they re-enter late, after significant recovery has already occurred, and they've missed the rebound on a base that is now smaller than it would have been. Fee drag is a less visible interruption but equally consequential over time. A fee taken each year isn't simply a reduction in that year's return. It's a removal of capital from the compounding base, capital that would have compounded for every remaining year of the holding period. A 1% annual fee on a portfolio held for 30 years doesn't cost 1% times 30. It costs the compounded value of that 1% removed every year over the entire 30-year period, which, at typical market return rates, can represent a significant portion of the total portfolio value at the end of the holding period. The fee doesn't reduce the portfolio linearly. It reduces the portfolio's compounding potential, which compounds forward from the moment of the fee for the entire remaining holding period. Withdrawals follow the same logic. Capital removed from a compounding portfolio isn't just the amount removed. It's the compounded value of that amount over the remaining holding period. A withdrawal of $10,000 from a portfolio with 20 years remaining at typical return rates doesn't cost $10,000. It costs what $10,000 would have become over 20 years of continued compounding, which can be a multiple of the original amount, depending on the return rate and the remaining time horizon. This doesn't mean withdrawals are never appropriate, but it means the true cost of removing capital from a compounding position is almost always larger than the amount removed. The structural conclusion is simple. Compounding rewards consistency and penalizes interruption, with a cost that compounds forward from the moment the interruption occurs. Every decision that removes capital from the base, every year of missed contribution, every panic sale, every fee paid to active management, every withdrawal made before the holding period ends, carries a cost larger than it appears. Because the cost isn't just the immediate amount, it's what that amount would have compounded into for every remaining year the position would have held. The mechanism is not complicated. It just requires being left alone, consistently, without interruption, long enough to produce what it was always capable of producing. If this shifted something for you, subscribe. Like this if it clarified something. Most investors spend most of their time on security selection. Which stocks to buy, which funds to hold, which sectors are positioned well, which individual positions will outperform the market. This is where the attention goes, the research, the analysis, the financial media coverage, the conversations among investors. And the research on what actually drives long-term portfolio outcomes consistently points somewhere else. Not at security selection, at allocation. The foundational research on this question was conducted in the 1980s and 1990s, examining what actually explained the performance variation across institutional pension funds over time. The conclusion was striking. Asset allocation, how capital was distributed across asset classes, explained the large majority of the variation in long-term portfolio returns. Security selection, which specific securities were held within each asset class, explained a much smaller portion. And market timing, moving in and out of asset classes based on predictions about direction, contributed almost nothing and was often negative. The asset class mix, equities, fixed income, alternatives, their proportions and relationships, was doing most of the work. Not the individual securities within each class, the structure of the portfolio itself. Why does allocation matter so much more than selection? Because asset classes behave differently from each other, in ways that individual securities within a class don't. Equities and bonds historically have moved differently in different environments. When equities decline sharply, as in recessions, investment-grade bonds have often held value or appreciated. When bonds decline, as in rising rate environments, equities have often continued performing. This relationship, not perfect, not consistent, but meaningful, means that a portfolio combining the two behaves differently from either one alone. Its volatility is lower. Its drawdowns during stress periods are smaller. Its recovery after declines is faster. The structural combination of asset classes produces properties that can't be replicated by selecting better securities within any one class. This matters practically because of how compounding interacts with drawdowns. A portfolio that declines 50% needs to return 100% just to get back to where it started. A portfolio that declines 30% needs to return 43%. The asymmetry of losses and gains means that limiting drawdowns through allocation has a compounding benefit that goes beyond simply feeling better during bad markets. It preserves more of the compounding base. It reduces the distance that needs to be recovered. It keeps more capital working through the recovery period. And more capital working through recovery compounds differently than less capital recovering from a deeper hole. This is why the investor who selects perfectly within a poorly structured portfolio often underperforms the investor who selects adequately within a well-structured one. The structure determines the range of possible outcomes. The selection determines where within that range you land. And the range set by allocation is wider than most investors believe, while the range influenced by selection is narrower than most investors assume. Most of the work is being done before a single security is chosen, by the proportions, by the asset class mix, by the structural decisions that determine how the portfolio behaves across different market environments. Security selection happens inside that structure. It matters, but it matters less than the structure it happens inside. Before this continues, if you felt seen instead of sold to, that's the entire point of Relentless Wealth. Like the video, subscribe. We're just getting started. Allocation is commonly understood as diversification. Don't put all your eggs in one basket. Own different things. Spread the risk. That's not wrong, but it's incomplete. Allocation, done structurally, is something more specific. It's the deliberate construction of a portfolio that captures different return streams with different risk profiles, and the balance between them determines how the portfolio behaves across different market environments. Every asset class has a return profile. Equities have historically generated the highest long-term returns, but with significant volatility and periodic severe drawdowns. Investment-grade bonds have generated lower long-term returns, but with lower volatility and typically better behavior during equity bear markets. Real assets, real estate, commodities, have behaved differently still, some providing inflation protection, some providing income, some with low correlation to both equity and bond markets. Each return stream has properties: expected return, volatility, correlation to other asset classes, behavior in different economic environments. Allocation is the process of combining these streams in proportions that reflect the investor's time horizon, their actual risk tolerance, their need for current income, their behavioral capacity to hold through volatility, to build a portfolio that behaves the way the investor needs it to behave. The proportions matter enormously. A portfolio that is 90% equities and 10% bonds will behave very differently from one that is 60% equities and 40% bonds, not just in returns, in the experience of holding it. The 90-10 portfolio will likely generate higher long-term returns. It will also experience larger drawdowns, deeper declines during recessions, more volatile periods that require more behavioral discipline to hold through. The 60-40 portfolio will likely generate lower long-term returns. It will also experience smaller drawdowns, a smoother ride, less behavioral pressure during market stress. Neither is objectively better. One is better for a specific investor, with a specific time horizon, a specific behavioral capacity, a specific set of financial needs. The allocation is a structural decision about what kind of portfolio that specific investor can actually hold and hold through to the destination. Return streams also interact with each other. The correlation between asset classes, how they move relative to each other, is as important as their individual properties. Two asset classes with high expected returns but identical return patterns that both decline in recessions and both rise in expansions don't provide meaningful diversification. Their combination produces a portfolio that behaves like a larger version of either one alone. Two asset classes with lower individual returns but low or negative correlation that move differently across market environments produce a portfolio with properties neither has alone. The combination is more than the sum of its parts. The portfolio behavior is a function of the correlation structure, not just the individual return profiles. This is where most individual investors make allocation errors. They focus on the expected return of each individual holding. They add holdings that look attractive in isolation. They build a portfolio that looks diversified from the outside, many different funds, many different tickers, but is concentrated in practice. Because many of the holdings are highly correlated, they behave similarly in the same environments. What looks like a diversified portfolio functions like a concentrated one when the market moves. The structural work of allocation isn't about the number of holdings. It's about understanding how those holdings interact across different environments and whether the combination actually produces the portfolio behavior the investor needs. Most investors treat allocation as a one-time decision. You set the portfolio, you select the proportions, you move on. And that approach, without what comes after it, produces a portfolio that drifts away from the intended allocation over time, in ways that change its risk profile without the investor realizing it. Here's how portfolio drift works. An investor starts with a 60-40 portfolio, 60% equities, 40% bonds. Over the next 5 years, equities significantly outperform bonds. The equity portion grows as a percentage of the total portfolio. Without rebalancing, without selling some equity and buying more bonds, what was a 60-40 portfolio has become a 75-25 portfolio, or 80-20, or more. The investor didn't intend to change the allocation. They didn't make a decision to take more risk. But the portfolio's risk profile has changed significantly through market movement alone. And the investor is now holding a different portfolio than the one they thought they had. Rebalancing corrects the drift. Periodically, annually, or when allocations have moved meaningfully from targets, the portfolio is brought back to the intended proportions. Selling asset classes that have grown beyond their target allocation, buying asset classes that have fallen below their target. Structurally, this is selling what has risen and buying what has fallen, which is the opposite of what emotional investors do, who buy what has risen and sell what has fallen, and which has a meaningful effect on long-term outcomes, not because it generates alpha, but because it maintains the intended risk profile and enforces a form of systematic discipline that most investors can't maintain behaviorally. Rebalancing also has a behavioral function. The investor who rebalances has a structural reason to act during both rising and falling markets that isn't driven by fear or greed. When equities have risen significantly, rebalancing means selling some, taking some gains, reducing the equity overweight. When equities have fallen significantly, rebalancing means buying more, adding to a declining position, restoring the equity allocation. Both of these actions are counterintuitive. Both of them are structurally sound, and both of them produce better long-term outcomes than the alternatives, which are chasing what has risen and fleeing what has fallen. The rebalancing discipline isn't about generating excess return. It's about maintaining the structure that was doing most of the work before any selection decisions were made. The investors who build strong allocation frameworks and maintain them through rebalancing consistently across market cycles don't necessarily beat the market. They do something more useful. They hold the structure that captures the return of the asset classes they own without the behavioral drift that converts their intended allocation into something they never chose. They stay at the allocation level where most of the outcome is being determined, instead of chasing returns at the security selection level where most of the effort produces less impact than most investors believe. The portfolio's structure was always doing most of the work. Rebalancing keeps that structure intact. And the discipline to maintain it through rising markets when selling feels wrong and falling markets when buying feels wrong is the behavioral work that most investors are unwilling to do consistently, which is why the research finding remains persistently underutilized, even by investors who've read the research. If this shifted something for you, subscribe. Like this if it clarified something. Most people enter the stock market with a specific understanding of what it is: a place where companies raise capital, a place where investors buy ownership stakes, a mechanism that prices assets based on the collective judgment of all participants. That understanding is partially correct, and the part that's missing is where most retail investors lose most of what they lose. Because the market isn't a neutral mechanism. It's a system, with structure, with participants who operate inside that structure very differently from each other, with advantages that are built in and distributed unequally. The first structural reality is that price discovery is asymmetric. In a genuinely neutral market, all participants would have access to the same information at the same time. Price would reflect the aggregate of equally informed decisions. That's not how markets work. Information flows to large participants first: institutional research, earnings guidance in private conversations with analysts, alternative data, satellite imagery of parking lots, credit card transaction data, shipping container counts, that quantifies what's happening inside companies before it appears in public filings. By the time information reaches the retail investor, through a news article, through a social media post, through a financial media segment, it has already been acted on by participants who had it earlier. The retail investor is not buying on the same information. They're buying on the residue of information that has already moved the price. The second structural reality is that execution is asymmetric. A retail investor submits an order. It routes through a broker. It executes at market price or at whatever the limit allows. An institutional participant operates differently. Algorithmic execution that breaks large orders into pieces to minimize market impact. Direct market access that routes orders to specific venues for the best available price. Co-location arrangements, where the trading infrastructure sits physically adjacent to exchange servers, reducing the time to execute by fractions of a millisecond. That speed advantage isn't trivial. In liquid, fast-moving markets, the price available a millisecond ago is not the price available now. And the participant who executes faster consistently gets better prices on both sides of every trade. Over thousands of transactions, that execution advantage compounds into a meaningful structural edge. The third structural reality is that the incentives of market participants are not aligned with retail investors. The broker makes money on order flow. The market maker makes money on the spread. The financial media makes money on engagement, which is driven by volatility and narrative. The fund manager makes money on fees, which are generated regardless of performance. None of these participants are structurally incentivized to help retail investors make better long-term decisions. The broker benefits when retail investors trade more. The media benefits when retail investors react to news. The fund manager benefits when retail investors delegate their capital management, regardless of what that capital subsequently does. The incentives of the ecosystem around retail investors are almost uniformly misaligned with the financial outcomes of retail investors. None of this means markets are a scam. None of this means retail investors can't generate returns through public markets. It means the market isn't the neutral, equal access mechanism it's commonly described as. It's a system with structural advantages built into specific types of participation. And the retail investor who understands what those structural advantages are, and who therefore understands which forms of participation work against those advantages and which ones don't, operates with a much clearer picture of what they're actually doing when they enter the market. Not a victim of the system, not trying to beat participants who have structural advantages in every relevant dimension. Using the market for what it actually offers to participants in their position, not what the ecosystem around them implies it offers. If this feels familiar, if you've felt this pressure but never had words for it, this channel isn't here to motivate you. It's here to help you see clearly. If that resonates, like the video. Subscribe. More clarity is coming. Institutional money doesn't behave the way retail money behaves. Not because institutional investors are smarter in some abstract sense, because they operate inside a different structural context, with different information, different tools, and different time horizons. And understanding how that context shapes their behavior changes how market movements get interpreted. The information environment is different. Institutional investors have research departments, teams of analysts whose only job is to understand specific sectors, specific companies, specific competitive dynamics. They have access to alternative data that retail investors don't. Geolocation data that tracks foot traffic, credit card transaction aggregates that show consumer spending in real time, satellite imagery that counts containers at distribution centers before earnings are reported. They have relationships with company management, through investor days, through analyst briefings, through the kind of access that comes with managing billions of dollars of capital. The information they act on is not the information available in a financial news article. It's more granular, it's more current, and it arrives earlier. The time horizon is different. A retail investor typically thinks about positions in terms of whether they're up or down, whether the thesis is playing out, whether it's time to hold or sell. Institutional investors operate across multiple time horizons simultaneously. Long-term fundamental positions held for years based on deep analysis of business quality and long-term earnings trajectory. Medium-term tactical allocations, adjusted based on macro conditions, sector rotation, or specific catalysts. Short-term trading activity that captures intraday or multi-day movements, often having nothing to do with fundamental analysis. These different time horizons operate simultaneously, and the activity they generate creates market movements that appear random to retail investors who are watching for fundamental explanations. The capital structure is different. An institutional investor managing a fund has obligations to its investors, performance benchmarks, redemption risk, the possibility that investors pull capital at an inopportune time, regulatory constraints on what can be held and in what concentrations. These constraints shape institutional behavior in ways that have nothing to do with their view of a company's value. A fund that has underperformed its benchmark may be forced to buy winning positions simply to reduce tracking error, not because the analysis supports the purchase. A fund facing redemptions may be forced to sell positions it wants to hold, creating price pressure that a retail investor watching the price move interprets as negative sentiment when it's actually mechanical selling. Most retail investors watch market movements and search for fundamental explanations. The stock dropped. What's the bad news? The stock rallied. What changed? But a significant portion of daily market movement has nothing to do with new information about the underlying business. It's institutional rebalancing. It's index reconstitution. It's fund flows driven by redemptions. It's algorithmic activity responding to price levels and volatility signals, not to earnings or competitive positioning. The retail investor who interprets all price movement as fundamental signal is reading a message that isn't always there, and making decisions based on the narrative they've constructed around movements that were generated by mechanics they weren't aware of. Given everything about how markets are structured, the information asymmetry, the execution advantage, the institutional mechanics that drive price movements retail investors can't anticipate, the logical question is, what should retail investors actually do? Not as a motivational answer, as a structural one, based on what the evidence shows about what works for participants in the retail investor's position. The first structural reality is that most active strategies don't work. Stock picking, selecting individual securities based on research and analysis, requires competing with institutional participants who have more information, better analysis tools, and faster execution. The evidence on retail stock picking over long time horizons is not encouraging. Not because retail investors are unintelligent, because they're competing against structural advantages in every relevant dimension: information, execution, and time. Market timing, moving in and out of markets based on predictions about direction, requires being right twice, on the exit and on the re-entry. The evidence on market timing across all categories of investors, including institutional ones, is equally discouraging. What does work for retail investors specifically is time and low costs. The structural advantage of the retail investor isn't information, isn't execution speed, isn't analytical capability. It's patience and the absence of institutional constraints. A retail investor doesn't face redemption risk. They don't have to manage tracking error against a benchmark. They don't have regulatory limits on concentration. They don't have performance review cycles that create pressure to show returns quarterly. They can hold positions through periods of volatility that would force institutional selling. They can ignore short-term noise that institutional investors are structurally required to respond to. That's a real structural advantage. It just looks like patience, which doesn't feel like an edge. Low-cost index exposure captures the return of the market without trying to beat the participants who have structural advantages, not as a consolation prize, as a structurally sound approach for a participant who is not equipped and structurally cannot be equipped to compete with institutional players on their own terms. The market generates real returns over time. Those returns are accessible through low-cost, broadly diversified exposure, without needing to predict which stocks will outperform, without needing to time entry and exit, without competing with participants who have every structural advantage. That's not giving up. That's correctly identifying the structural position of the retail investor and playing to the actual advantages that position contains. The financial ecosystem around retail investors doesn't frame it this way. The ecosystem benefits when retail investors trade more, when they believe they can beat the market, when they engage with the narrative and react to the volatility and generate the order flow that makes the ecosystem profitable. The structural understanding of what retail investors can and can't do and why is not in the financial ecosystem's interest to promote, but it's in the retail investor's interest to hold. Because the investor who understands the structural reality of markets, who doesn't compete where they can't win, who uses what they actually have, patience, low costs, the absence of institutional constraints, generates better outcomes over time than the investor who tried to play the institutional game without institutional tools. If this shifted something for you, subscribe. Like this if it clarified something. There's a number that doesn't get discussed enough in conversations about investing. Not the market's return, not a fund's return, the investor's return. The return actually earned by the people holding the fund, as opposed to the return the fund itself generated. And the gap between those two numbers, documented across decades of data, across fund categories and geographies, is significant. Investors in the same funds consistently earn less than the funds themselves return. The gap has a name. It's called the behavior gap, and it emerges from a specific pattern. Investors don't hold funds passively through the full return period. They enter and exit, based on how they feel about the market at various points along the way. They enter after periods of strong performance, after the fund has already risen significantly, after the conditions that produced the gain are already reflected in the price. They exit after periods of poor performance, after the fund has already declined, after the pain of holding through the drawdown has become too significant to sustain. And by entering late and exiting early, by buying high and selling low, they capture a fraction of the return that a patient, undisturbed holder of the same fund would have earned. The data on this is consistent and striking. Research tracking investor returns versus fund returns over long periods shows the average investor earning meaningfully less than the average fund. Not because the funds were bad, because the investor behavior inside the funds was generating returns that diverged from the fund's actual performance. The investor was using the same vehicle, taking more or less the same market exposure, but through the timing of their entries and exits, through the behavioral choices they made about when to be in and when to be out, they were converting a reasonable long-term return into a worse one. Not through fraud, not through bad fund selection, through the timing of their own decisions. The behavior gap compounds over time. A 1% annual difference between fund return and investor return doesn't sound significant. Over 20 years, it produces a meaningfully different ending position. Because the investor who earned less per year had a smaller compounding base, and a smaller compounding base generates smaller returns, which compounds into a smaller base, which generates smaller returns. The gap between fund return and investor return isn't additive, it's multiplicative. It compounds in the same direction as the returns themselves, just against the investor. The market return is what's available. The investor return is what gets captured. And the gap between them, the behavior gap, is the cost of the emotional relationship most investors have with markets. Not the cost of bad fund selection, not the cost of high fees, not the cost of bad luck. The cost of entering and exiting at the wrong points, driven by how the market felt rather than by the underlying investment logic, paid consistently, year after year, compounding against the investor for the entire holding period. The behavioral errors that produce the gap aren't random. They follow predictable patterns. They occur at predictable times. They're driven by predictable psychological mechanisms that have been documented across decades of behavioral finance research. Understanding the specific errors, not as personal failures, but as predictable behavioral patterns, is the beginning of building a framework that reduces them. The first error is loss aversion. Losses feel approximately twice as painful as equivalent gains feel pleasurable. This isn't a weakness of character. It's a feature of human psychology, one that likely served an evolutionary purpose in environments where losses were genuinely dangerous. But in an investing context, where temporary price declines are a normal feature of the journey rather than a permanent threat, loss aversion produces a specific error. It makes holding through drawdowns disproportionately painful. A portfolio down 20% feels worse than its actual financial impact. The psychological weight of the loss exceeds the rational assessment of it, which produces the impulse to sell, to stop the pain at exactly the wrong moment, when the position is most likely to recover, when the entry point for new investors is most attractive. The second error is recency bias. Investors overweight recent performance when projecting future performance. After a long bull market, after several years of strong returns, investors extrapolate that trajectory forward. The market has been going up. It will keep going up. And they increase exposure, buy more, take on more risk, precisely as the market reaches a point where the expected forward return is lower than it has been. After a significant decline, after a bear market has been painful and the news is uniformly negative, investors extrapolate that trajectory forward. The market has been going down. It will keep going down. And they reduce exposure, sell, move to safety, precisely as the market reaches a point where the expected forward return is higher than it has been. Recency bias inverts the rational relationship between price and attractiveness. It makes things feel most attractive when they're most expensive, and least attractive when they're most compellingly valued. The third error is overconfidence. Investors consistently overestimate their ability to predict market direction, identify winning securities, and time their entries and exits successfully. The evidence on this is consistent. Most investors who believe they have an edge don't generate the returns their confidence implies they should. Overconfidence produces excessive trading, more portfolio turnover than the strategy requires, more taxable events, more opportunities for timing errors, more costs. And the additional activity, the expression of the overconfidence, produces lower returns than the passive baseline that requires no prediction and no timing. These three errors, loss aversion, recency bias, overconfidence, interact with each other. A declining market triggers loss aversion, producing the impulse to sell. Recency bias reinforces it. The declining trend feels like it will continue. And overconfidence provides the justification. The investor believes they can identify the right moment to re-enter after the decline has run its course. The combination produces the classic behavioral pattern, selling into weakness and buying back into strength, which is the precise sequence that generates the behavior gap, converting the market's long-term return into a materially lower investor return. If this feels familiar, if you've felt this pressure but never had words for it, this channel isn't here to motivate you. It's here to help you see clearly. If that resonates, like the video. Subscribe. More clarity is coming. Behavioral errors in investing are commonly framed as personal failures, a discipline problem, an emotional weakness, something to be overcome through willpower and better decision-making. That framing is wrong, and it matters that it's wrong, because misidentifying the source of the error produces the wrong solution. Behavioral errors in investing aren't failures of character. They're the predictable output of cognitive systems that evolved for a different environment than the one investors are operating in. Human cognition evolved in an environment where threats were immediate and physical, where a rustling in the grass required an instant, instinctive response, not careful deliberation. The cognitive systems that made that response possible, fast, emotionally driven, pattern recognizing, loss averse, were adaptive in that environment. In an investing context, where the threats are abstract, where the appropriate response to a decline is often to do nothing or to buy more, where the time horizon is decades rather than seconds, those same cognitive systems produce systematically wrong responses. Not because the investor is failing, because the cognitive hardware was built for a different operating environment. The financial ecosystem around investors is designed to exploit this mismatch. Financial media profits from engagement. Engagement is driven by anxiety. Anxiety is produced by urgency. Urgency is manufactured through the framing of every market movement as something that requires an immediate response. Breaking news, market alert, what you should do now. Each of these is designed to activate exactly the cognitive systems that produce the worst investment decisions, the fast, emotionally driven, loss-averse responses that sell into weakness and chase strength. The media doesn't profit from long-term investor returns. It profits from the attention generated by the anxiety those returns produce when they're framed as daily events requiring constant monitoring and response. Brokerage platforms are similarly designed. The tools available to most investors, real-time quotes, news feeds, analyst ratings, portfolio alerts, are all instruments that increase the frequency of engagement with the portfolio. And increased engagement increases the opportunity for behavioral error. The investor who checks their portfolio daily has more opportunities to react to short-term movements that are irrelevant to their long-term outcome. More opportunities to see a decline and feel the loss aversion. More opportunities to see strength and feel the recency bias pulling them in. More opportunities to make a decision that the long-term investor they intend to be wouldn't make. Understanding the structural source of behavioral errors changes what the solution looks like. The solution isn't more willpower. It isn't trying harder to be rational in the moment when the market is declining. The solution is structural. It's changing the environment in which the investment decisions get made, reducing the frequency of engagement, removing the triggers that activate the wrong systems, building rules that govern behavior before the conditions arise that would compromise it. The behavioral errors aren't personal, but the framework to reduce them has to be personal, built specifically for the investor who understands how their own cognition interacts with the environment the financial ecosystem has created around them. A behavioral framework for investing isn't about eliminating emotion. Emotion can't be eliminated, and trying to suppress it usually produces the opposite of the intended effect, the suppressed response finding a different expression at a different moment. The framework is about something more structural, removing the conditions under which emotion produces the most damaging decisions. The first structural element is reduced monitoring frequency. The investor who checks their portfolio daily has 250 opportunities per year to react to market movements. The investor who checks quarterly has 4. The reduction in monitoring frequency is not a reduction in information. The market's long-term trajectory isn't meaningfully changed by what happens in any given week. The reduction is in the number of opportunities to make an emotionally driven decision that the long-term investment rationale doesn't support. Fewer touchpoints means fewer activation events for the cognitive systems that produce loss aversion and recency bias. It's not about being uninformed. It's about not giving yourself 250 chances per year to make the same expensive mistake. The second structural element is pre-committed rules. Rules established before the conditions arise that would require using them. Not selling in a decline of more than X% unless specific fundamental conditions change. Rebalancing when allocation drifts beyond Y%, regardless of market direction. Continuing contributions regardless of market level, not increasing them when markets are performing well and not reducing them when they're not. These rules don't require emotional override in the moment. They require a decision made in advance, in calm conditions, that governs behavior when conditions are no longer calm. The behavioral framework operates before the emotion arrives, not during it. The third structural element is written investment rationale. A clear, specific, written articulation of why each position is held, what the expected long-term case is, what the basis for that expectation is, what would actually constitute a reason to change the position. During a market decline, when the emotion is present, when the cognitive systems are activated, when the impulse to act is strong, the written rationale provides a reference point created in calm conditions, not an argument against selling, a check against the specific question. Has anything changed about the fundamental case that justified holding this position? If no, the written rationale holds. The position holds. The behavioral error doesn't occur. None of this is complicated. The behavioral framework isn't sophisticated. It doesn't require advanced financial knowledge or exceptional discipline. It requires 3 things: checking the portfolio less often, having pre-committed rules that govern behavior during specific conditions, writing down why each position is held, and consulting that rationale before any significant decision is made. These structural elements don't produce better market predictions. They don't generate alpha. They don't make the investor smarter than the market. They reduce the frequency of the specific behavioral errors that cost most investors the gap between market returns and the returns they actually capture. The market return is available. The behavioral framework is what determines how much of it you actually get. If this shifted something for you, subscribe. like this if it clarified something. Before any discussion of strategy, before active versus passive, before stock picking versus indexing, there's a mathematical reality that shapes every outcome before a single investment decision is made. Cost. Not as an abstract concept, as a compounding drag that operates continuously against every dollar in the portfolio. A 1% annual fee sounds inconsequential. 1%, a small number, an amount that feels like a reasonable cost for professional management. But fees don't operate on a single year's return. They operate on the compounding base, and the drag they create isn't additive, it's multiplicative. Consider two portfolios, both starting at the same amount, both generating the same gross return. One with a 1% annual fee, one with a cost of nearly zero. After 20 years, the difference in ending value is not 1% per year compounded. It's the entire compounding differential of a portfolio that kept one more percentage point working for 20 years versus one that gave that percentage point to a manager every year. The fee doesn't just reduce returns. It removes capital from the compounding base, capital that would have generated returns on returns on returns for the entire remaining holding period. The fee drag problem is compounded by tax inefficiency. Active management involves trading, buying and selling positions as the manager's view on value changes. Every sale of a profitable position generates a taxable event. Short-term gains taxed as ordinary income, long-term gains taxed at capital gains rates. In a taxable account, the active fund that trades regularly is generating tax obligations on behalf of the investor every year the fund is held. Not just on distributions, on the trading activity inside the fund, trading the investor didn't initiate and may not have chosen. An index fund, held for years, generates minimal trading, minimal turnover, minimal taxable events beyond the investor's own decisions. The tax drag of active management adds to the fee drag, compounding the headwind that the active strategy has to overcome just to break even with the passive alternative. The headwind number matters. If the market generates 8% annually and an active fund charges 1.5% and generates another 0.5% in tax drag, the active fund needs to generate 10% gross returns just to deliver what the index provides net, consistently, year over year. In a market where consistently generating 2% alpha, 2% above what a passive strategy captures, is something the evidence shows almost no manager does sustainably. The fee and tax headwind isn't a small disadvantage to overcome. It's a structural barrier that most active strategies never clear. This is not a commentary on fund manager intelligence, or effort, or analytical capability. It's a mathematical observation about the relationship between costs and compound returns over time. The investor who pays more needs more gross return to end up in the same place. And in a market where information is widely disseminated and prices rapidly reflect what's known, generating that additional gross return consistently is structurally harder than it appears from the outside. Before strategy, before manager selection, before any analysis of active versus passive, the cost structure has already shaped the probable outcome. And in most cases, it has shaped it against the active investor. Active management underperforms not because fund managers are unintelligent. The people running actively managed funds are among the most analytically capable in the investment industry. deep research, sophisticated models, access to information retail investors can't access. And yet, the data on active management performance over long time horizons is remarkably consistent. Most actively managed funds underperform their benchmark index over periods of 10 years or longer. Not most bad funds, most funds, including the ones run by capable people with significant resources. The underperformance isn't about capability, it's structural. The first structural cause is the efficiency of the market itself. In markets where information is widely available, where thousands of analysts and fund managers are examining the same securities, building similar models, arriving at similar conclusions, the price of a security rapidly reflects the aggregate of all that analysis. Which means that finding a security that is meaningfully mispriced, that represents genuine value not yet reflected in the price, requires being right when thousands of other analysts are wrong. Not occasionally, consistently, year after year, with enough frequency to overcome the cost headwind and still deliver excess returns. In highly efficient markets, that's what alpha generation requires, and it's much harder than most investors manage their expectation of the difficulty. The second structural cause is the benchmark problem. Actively managed funds are measured against a benchmark, usually a market index, and that measurement creates a specific behavioral dynamic. A manager who holds positions very different from the index, who takes the concentrated, differentiated positions that would be required to generate meaningful alpha, is exposed to significant tracking error. If those positions underperform, even temporarily, the manager faces redemptions. Investor capital leaves the fund. The manager's career is at risk. So the rational response for most fund managers is to hold a portfolio that looks similar enough to the benchmark to limit career risk, while still charging fees for active management, which produces a portfolio that's unlikely to dramatically underperform, but equally unlikely to dramatically outperform after fees. The incentive structure of active management pushes toward closet indexing, paying active fees for near-passive exposure. The third structural cause is mean reversion in performance. A fund that outperforms in one period is not statistically likely to outperform in the next. The evidence on performance persistence, on whether last decade's top-performing funds are this decade's top performers, is weak. Outperformance is more often explained by factor exposures, by tilts towards certain types of securities that happened to perform well in a given period, than by persistent manager skill. When those factor exposures revert, when the market environment changes, the prior outperformance reverses, and investors who chased the prior performance have arrived at the party after the best returns have already been captured. None of this means active management never outperforms. Some managers do, in some periods, in some asset classes where information is genuinely less efficient. But the question for any investor considering active management isn't whether it's possible to outperform. It's whether the specific manager they're choosing will do so, net of fees and taxes, over the specific time horizon they're investing for. And the evidence on that question, consistently, across time horizons and geographies, says most won't. Not because they can't analyze, because the structural properties of markets, costs, and manager incentives are working against them before the first trade is placed. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. Index investing is consistently misunderstood as settling for average. The logic seems straightforward. An index fund owns everything. It captures market returns. It doesn't try to beat anyone. And in a world where winning feels like finding the right stock, timing the right entry, selecting the right manager, not trying feels like not competing, like accepting second place, like giving up before the race starts. That framing is wrong, and understanding why changes how index investing is actually evaluated. An index fund doesn't capture average returns. It captures market returns minus a very small cost. The distinction matters because of what's on the other side. Active strategies don't capture market returns plus the value of active management. They capture market returns minus fees, minus trading costs, minus tax drag, minus the performance cost of the positions that underperformed while the manager searched for the ones that didn't. In aggregate, across all active investors, the market return is what exists. It's the return available before any costs are applied. Active investors in aggregate earn the market return, then pay fees, then pay taxes, then end up below the market return. Index investors in aggregate earn the market return, then pay a very small fee, then end up just below the market return, but above the average active investor. This isn't a strategy preference, it's arithmetic. What passive investing actually provides is a structural elimination of friction, not skill, not research, not prediction. The removal of the costs that cause most active strategies to underperform the market they're trying to beat. Low turnover means minimal trading costs, minimal taxable events in taxable accounts, low fees that don't compound against the investor's returns year after year. The index fund doesn't win by being smarter than the market. It wins by not losing to its own costs, which, given the structure of how markets work and how costs compound over time, is an enormous structural advantage. There's a second property of index investing that gets underappreciated: behavioral consistency. Active investing creates conditions that are hostile to good investor behavior. Performance that varies dramatically from the market creates emotional pressure. When the fund lags the market, which happens regularly even for good managers, the investor faces the question of whether to hold or sell, whether the underperformance is temporary, a period to hold through, or permanent, a signal to exit. That question, repeated across down periods, produces a specific behavioral pattern: selling after underperformance, buying after outperformance, the exact opposite of what produces good outcomes. Index investors face a simpler version of that question. The fund tracks the market. Periods of underperformance are the market underperforming. The question is whether to believe in long-term market returns, not whether this specific manager is still worth holding. That simplicity doesn't eliminate behavioral error, but it reduces the frequency of the conditions that produce it. Index investing is not a philosophy of mediocrity. It's a structural approach that correctly identifies where the friction in the investment process lives: in costs, in taxes, in behavioral error, and eliminates as much of it as possible. The investor who understands this isn't settling. They're removing the structural obstacles between their capital and the returns the market actually generates. And that removal, applied consistently over a long enough time horizon, compounds into something that most active approaches never match. The persistent outperformance of passive over active investing over long time horizons isn't an anomaly that will eventually correct. It's a signal. a signal about the structure of markets, about what information is already priced in, about what it actually costs to try to extract returns above the market, about the nature of the competition retail and even institutional investors are facing when they attempt to do so. The first thing the data signals is that markets are more efficient than most investors believe. Efficiency in this context has a specific meaning. Not that prices are always right, not that mispricings never exist, but that known information is rapidly reflected in prices, rapidly enough that finding it first or analyzing it more accurately is harder than the cost of trying makes it worth. The market isn't perfectly efficient, but it's efficient enough that the edge required to overcome the cost of active management is not reliably achievable by most participants. And the data on active manager performance over long periods, across markets, across fund categories, across geographies, confirms that conclusion with remarkable consistency. The second thing the data signals is about the nature of the competition. Active investing is a zero-sum game before costs. For every dollar that outperforms the market, there's a dollar that underperforms, by definition, in aggregate. And the participants competing for the outperforming dollars are not equally distributed. Institutional investors with full research teams, alternative data access, algorithmic execution, and decades of pattern recognition are competing against retail investors with a brokerage account and a financial media diet. In that competition, for the same zero-sum pool of outperformance, the outcome over time is predictable. The retail investor who attempts to pick stocks, to time markets, to select the right active manager is generating the underperformance that funds the institutional outperformance. The third signal is about what complexity costs in the investment context. Most investors assume that more complexity produces better results, more analysis, more trading, more sophisticated strategy, more active management. The evidence consistently shows the opposite. Complexity in investing primarily adds costs in fees, in taxes, in trading friction, in behavioral errors generated by the emotional complexity of active decision-making. Simplicity, owning a broad, low-cost index, eliminates most of those costs without sacrificing the underlying market return. The counterintuitive conclusion that the evidence supports is that in investing, unlike most domains of performance, doing less usually produces better results than doing more. What the persistent outperformance of passive ultimately says about the market is this: the market is not a place where most participants can reliably extract returns above what the market itself provides, after accounting for the cost of trying. It's a mechanism that efficiently allocates capital and generates returns for participants who are positioned to receive those returns with minimal friction. The investor who understands this, who positions themselves to receive the market's return rather than to extract alpha from it, is working with the structure of markets rather than against it. And over a long enough time horizon, with low costs, with consistent behavior, with the compounding running uninterrupted, that alignment with the structure produces outcomes that most active approaches never reach. If this shifted something for you, subscribe. Like this if it clarified something. Volatility and risk are used interchangeably in almost every financial conversation. Market volatility is risky. High volatility assets are higher risk. Reducing volatility means reducing risk. These statements feel true. They're repeated constantly. They shape how most investors think about portfolio construction, asset allocation, and the decisions they make during periods of market turbulence. And they're imprecise in a way that costs investors money. Because volatility and risk are not the same thing. They're related, but they're different. And the difference between them is where most of the expensive behavioral errors in investing originate. Volatistical property. It measures the magnitude of price movement, how much an asset's price fluctuates around its average or trend. A highly volatile asset moves up and down dramatically. Its price in any given week or month can be very different from its price the week or month before. A low volatility asset moves more smoothly. Its price changes are smaller and more predictable in the short term. Volatility is a description of price behavior. It's a property of how an asset moves, not a statement about where it ends up. A highly volatile asset can end up significantly higher than it was before the volatility. A low volatility asset can end up significantly lower. The volatility doesn't determine the destination, it describes the journey. Risk, in the sense that matters for investors, is something different. Risk is the probability of a permanent loss of capital, not a temporary decline in price, not a period of negative returns, not a drawdown that gets recovered. A permanent loss, capital that doesn't come back, a position that ends materially below where it started with no recovery. That's the risk that actually matters for someone with a long time horizon, not how much the price fluctuates on the way to the destination, whether the capital actually arrives. The confusion between these two definitions has a specific behavioral consequence. When investors treat volatility as risk, when they interpret price fluctuations as signals of potential permanent loss, they make decisions calibrated to the wrong thing. They sell when prices fall, because falling prices feel like increasing risk, when in most cases they represent increasing volatility in a position that will ultimately recover. They hold cash or low volatility assets because they feel safer, when in reality they're accepting a different and often larger risk, the certainty of earning below inflation returns while avoiding the discomfort of price fluctuation. They time the market, trying to avoid volatile periods, when the evidence consistently shows that timing attempts reduce long-term returns by removing investors from the market during recoveries that follow sell-offs. The definitional problem isn't semantic, it's behavioral. How risk is defined determines what decisions feel rational. If volatility is risk, selling during a sell-off is rational. Moving to safety during turbulence is rational. Avoiding high volatility assets is rational. If risk is permanent loss of capital, none of those decisions are obviously rational. Some of them are demonstrably harmful to long-term outcomes. The definition you hold shapes every decision you make during the periods when markets are most turbulent. And most investors are holding the wrong definition because it's the one they were handed by a financial industry that profits from the behavioral patterns that definition produces. Volatility is price movement, up and down, around a long-term trend, sometimes dramatically, sometimes in ways that feel alarming when experienced in real time. But price movement is not the same as loss. And understanding what volatility actually is, mechanically, structurally, changes how it gets experienced and how it gets responded to. Markets move around a long-term trend. Over long periods, decades, broad market indexes have historically moved upward. Not smoothly, not in a straight line, with significant interruptions, recessions, bear markets, crashes, periods where prices fall 30, 40, 50% and feel, in the moment, like they might not recover. But the trend has been upward, and the periods of significant decline have been temporary relative to the holding period of a long-term investor. Volatility is the mechanism through which the market moves around that trend. It's the noise surrounding the signal. For the long-term investor, the investor who doesn't need to sell, volatility is a property of the journey, not a threat to the destination. A 30% decline in price is alarming to an investor who needs to sell in the next year. It's less alarming and much more manageable for an investor whose holding period is 20 years, because a 30% decline in a position held for 20 years is a temporary disruption to a long, compounding trajectory, not a permanent loss unless the investor converts it into one by selling. The holding period determines how volatility should be experienced, and most investors have holding periods longer than they behave as if they do. Volatility also has a second property that most investors ignore. It creates opportunity. A price that has declined significantly represents an asset available at a lower cost, more ownership for the same capital, higher expected future return from a lower starting price. The investor who continues contributing during a period of market decline, who buys more units at lower prices, is positioned differently at recovery than the investor who stopped contributing or sold. They own more of the asset at a lower average cost. The recovery lifts a larger position. The compounding starts from a better base. This is the mechanism behind dollar-cost averaging during downturns, not as a strategy, but as a structural consequence of consistent investment behavior during volatile periods. The investor who experiences volatility as threat makes decisions that eliminate this opportunity. They sell into declines, converting temporary paper losses into permanent realized losses. They stop contributing during downturns, missing the opportunity to accumulate at lower prices. They wait for the market to stabilize before re-entering, which means re-entering at higher prices after the recovery has already happened. Each of these behaviors is a rational response to volatility if volatility is the thing being avoided. Each of them is a costly behavioral error if the actual goal is long-term capital accumulation through a compounding position. Volatility isn't the problem. The response to it is, and the response is determined by how it's defined. If this made sense to you, you already understand more than most people do. This channel exists for that kind of awareness. Like the video, subscribe. Nothing here is accidental. If volatility isn't the risk, what is? For the long-term investor, the investor whose time horizon extends years or decades, the risk that actually matters is the permanent loss of capital. Not a temporary price decline, not a period of negative returns, not a drawdown that recovers, a permanent loss. Capital that ends materially below where it started, with no recovery. Understanding the actual conditions under which permanent loss occurs changes how portfolio decisions get made. Permanent loss in a broadly diversified position requires a specific set of conditions, not just a market decline that doesn't recover. For a broadly diversified position, one that owns hundreds or thousands of companies across sectors and geographies, a permanent, non-recovering decline requires something much more severe than a typical recession or bear market. It requires a structural failure of the economic system underlying the portfolio, a scenario in which the productive capacity of a diversified collection of businesses fails to recover, permanently. That scenario has never occurred in developed market history over long time horizons. Not during the Great Depression, not during World War II, not during any of the significant crises that produced sharp, alarming market declines. The market recovered. Not immediately, not smoothly, but it recovered. The actual risk conditions for a long-term investor are different from what volatility suggests. The primary risks are permanent loss through company-specific failure, holding a concentrated position in a company that goes bankrupt. This is why diversification matters. It eliminates the risk that any single company's failure destroys the portfolio. Permanent loss through behavioral error, selling during declines, failing to stay invested long enough for the compounding to work, making timing decisions that exit the market before recovery and re-enter after. This is the risk that most investors actually face, and it has nothing to do with the market. It's self-inflicted. Permanent loss through inflation, holding too much in low-return assets for too long, allowing purchasing power to erode while avoiding short-term volatility. This is the risk that feels safe but consistently destroys wealth over long time horizons. The behavioral error risk deserves particular attention because it's the most common and the most avoidable. An investor who holds a diversified position, who doesn't sell during declines, who stays invested through volatility, is not significantly exposed to permanent loss in a structural sense. The same investor, if they sell during the 2008 decline, if they exit in March 2009, locks in a 40% loss. If they then wait for the market to stabilize before re-entering, they miss the recovery that followed. And the gap between where they exited and where they re-entered is a permanent loss. Not because the market failed, because they converted volatility into permanent loss through a behavioral decision. The risk for most long-term investors isn't in the market. It's in how they respond to the market. And the misidentification of volatility as risk, the treatment of price movement as a signal of permanent danger, is what drives the behavioral decisions that actually create the permanent losses they were trying to avoid. The storm is real. The volatility is real. The price movements are real. But for the investor with a long enough time horizon and a diversified enough position, the volatility is not the risk. The response to it is. Understanding the distinction between volatility and risk is not enough on its own. Because understanding something intellectually and maintaining that understanding when markets are falling, when every financial media outlet is alarmed, when the portfolio is down 30%, when friends and colleagues are selling, are two different things. The behavioral framework that allows long-term investors to hold through volatility has to be built before the volatility arrives, not during it. The first element of the framework is clarity about time horizon. An investor whose holding period is 20 years should not be making decisions based on what the market does this week. That sounds obvious, but most investors don't have a clear, explicit articulation of their time horizon, one that they've committed to and that guides their behavior during turbulent periods. Without that clarity, the time horizon compresses under emotional pressure. What was a 20-year investment becomes a 10-year investment, becomes a 5-year investment, becomes a decision made based on today's price. And the long-term investor makes short-term decisions, not because their actual time horizon changed, because the clarity about it wasn't established firmly enough to hold under pressure. The second element is a written investment rationale, not a strategy document, not a financial plan. A clear articulation, in writing, of why the position is held, what the expected long-term return is, what the basis for that expectation is, what conditions would actually justify changing the position. The purpose of the written rationale is to create a reference point that exists before the volatility occurs, when thinking is clear, that can be consulted during the volatility when thinking is emotionally compromised. A decision made in the middle of a market panic is not the same quality of decision as one made in calm conditions. The written rationale is a mechanism for carrying the calm condition thinking into the panic condition moment. The third element is deliberate exposure reduction, not elimination of risk assets, not a move to cash during volatile periods. A portfolio that is sized correctly for the investor's actual risk tolerance, not their stated risk tolerance, is one they can hold through volatility without the emotional pressure to sell becoming overwhelming. An investor who is overexposed to equities, who holds more than they can emotionally sustain through a 30% decline, will sell at the worst time. Not because they're undisciplined, because the position was never calibrated to their actual behavioral capacity. The right portfolio isn't the one that produces the highest theoretical return. It's the one the investor can actually hold through the conditions that will inevitably arrive. Volatility will arrive. That's not a prediction. It's a structural property of markets. The investor who has clarity about time horizon, a written rationale for their positions, and a portfolio sized to their actual capacity experiences volatility differently than the investor who doesn't. Not because the price movements are smaller. They're the same price movements. Because the behavioral response is different. The framework holds. The position is maintained. The compounding continues. And the volatility that converted the underprepared investor's position into a permanent loss becomes, for the prepared investor, the noise that surrounded a long-term return they were positioned to receive. If this shifted something for you, subscribe. Like this if it clarified something.